One of the biggest telltale signs that precedes a recession isn't the bad data or EPS revisions. It's normally a rise in leverage and a euphoric boom that makes everybody think everything is going to be okay. So today we are going to discuss what happens during a recession, will we get one, and how to position our portfolios accordingly. But we also need to talk about oil. It's making some of the craziest moves today, outpacing treasuries in volatility. And we also need to discuss dark pools. There was some incredibly worrisome signs that we really do need to talk about and dissect further. Hello ladies and gentlemen, welcome to the Daily Recap Show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. And it was a red day overall. The big boys producing most of the losses, and the biggest winning sector today, utilities. Absolutely crazy, as well as industrials and some smaller names in healthcare outpacing most of the rest of the market. And this is all a part of December's normal seasonal weakness. When we've had a year that's greater than 10%, we can expect volatility at the start of the month and then a bottom anywhere between today and the 14th of December before we do see the seasonal run up. And I posted this on my YouTube. A lot of you guys were bearish. This was just a poll, the weekend poll. I do these every single weekend. So go ahead, subscribe to my YouTube channel so you don't miss these. And it was 93 votes, so it's not anything significant. But 52% of you were bearish, 48% of you were bullish. And it seems this week the bears are winning because we had quite the bearish day today. And before we continue this video, guys, I want to make a very quick disclaimer. I'm going to be talking a lot about a recession, incoming recession, potentially a soft landing. I want each and every single one of you to know that I am bullish on America and I am bullish. I want each and every single one of you to know that I am bullish on America and I am bullish on Australia, on their economies and their long-term outlook. All of this, everything I'm about to talk about in a soft landing or a recession, it's all going to be within the next 3 to 6 months. I'm still quite bullish on 2024, towards the end of 2024, 2025. Okay, so let's get into it. Let's discuss the majors. And this is what we saw here, guys. Okay, this is what we saw. The ADP numbers released, and a lot of the stocks, especially the Russell, gapped up. Then we saw a major sell-off. So a bit of a bull trap here, especially in the smaller names. And the Russell going from peak to trough, nearly 2% in a drawdown. Same with the S&P 500, the Nasdaq. You're looking at something like very close to a 1% drawdown in each of those indices. This had to do with the ADP employment data. It simply had to. Have a look here, 103 versus 130,000 estimate. You have to, but now breaking this down, now looking at this holistically, you are actually seeing an increase in employment, although it was just a bit slower, but the cracks are appearing in the economy. I put this on Twitter, so go ahead and follow me on Twitter if you want the latest updates during the trading day. Now, it was actually a thread, and I went on to further say that the October trade balance was that, non-farm productivity was that, Q3 labor costs came in better than expected. These were all good things, and I said that these are going to be positives for the market today. And this is probably one of the reasons why I also saw that bid up in the early morning trade before the sell down. And I did say we need to observe which data point the market will give greater importance to, because we had average ADP numbers, pretty good trade balance, non-farm productivity numbers, and it seems that the market weighted the ADP numbers much more. And on top of all of this, we got a significant decline in oil. Crude and Brent down 4%, 3 to 4% on the day. Absolutely crazy volatility. And this volatility has actually more to do with supply issues than anything else. OPEC is having they're pledging major cuts, but I just don't think that people the OPEC countries are going to enforce those cuts. And that's what people are seeing. They're seeing the lack of demand globally, cuts not being enforced. And this is why oil is falling to, I believe, June or July, March lows, somewhere around there. Now, but I'm seeing a lot of people on Twitter talk about oil. The signal for downside is not oil, guys. Oil is actually historically, its volatility right now is completely within normal means. If you want to look for a sell signal, if you want to look for a recession signal, you have to look at treasuries, okay? Now, look at this. XLU, XLY, XLV, those are the best performing sectors today, as well as staples, outperforming the SPY significantly. Look at the worst performing sectors: semiconductors, technology, metals, materials, energy, miners, the worst performing. So these rate sensitive stocks were the worst performing. These were the best performing. What's actually happening here? It's a rotation into defensives, utilities, industrials, healthcare. Those are defensive names, and we're seeing a rotation into that. I believe all of this has to do with the Fed's tightening. I do believe that the Fed have over-tightened and we will see extremely weak economic data and a very, very mild recession. We're going to see one of two things: an extremely mild recession or a very bumpy soft landing. This is what we're going to get. It's not going to be a severe recession because this recession is caused by the Fed over-tightening. And this is why I believe we're going to see an aggressive rate cutting cycle in Q2, Q3, potentially Q1, the first cut coming in Q1 next year. Maybe March, maybe the February. But, in this time period, I do think we're going to see an aggressive rate cutting cycle. I think anywhere from 150 to 250 basis points worth of cuts. And now I'm not saying go YOLO deep out of the money puts on downside risk, because this sell-off looks completely normal. This looks orderly. Small caps have this type of volatility. Stocks have this type of volatility. This is the volatility you have to contend with in the market. It's what you get with stocks. You want less volatility? Go hold some cash or go buy a 3-month treasury bill. Okay. We are still following seasonals. Look at small cap seasonality. Normally we get like this dip into the middle of December before we have a run up. It's what we could be seeing in the Russell. I'm not saying the sell-off starts right now. I'm not saying the recession sell-off or the soft landing sell-off starts right now. As everything stands, we're following seasonality perfectly the way we should, especially in the small caps. And small caps, can actually make a bottom between now and the next 3-4 trading days and rally into January. They can definitely do that. But I am seeing signs around that's pointing towards a lot of other things, and we are going to talk about them in the rest of the video. Now, December is normally a bullish month. The same is true for the S&P 500 and the NASDAQ. Now, let's just go over the basics, okay? Pre-election year seasonality. Look at the S&P 500. The average return, 2.9% in a pre-election year, 2.9% return in December, 13 up years, 5 down years. Very, very positive. Now, look at normal market performance, 1950 to 2022. This is 72 years, very statistically significant. 54 up years, 19 down years, 74% of the time higher, 1.4%. 72 years of data. Very, very good, right? And we do have to follow the stats. We cannot discount the fact that there are signs, stuff like 401k withdrawals spiking by 300%. Have a look at this and look at the returns that we normally see when we see hardship withdrawals upward of 300%. 12-month returns and median returns, negative 15.6% in the S&P 500. An average gain of 7.2, max loss 22%. So the risk to reward, not quite there, only positive 22% of the time. And this is also true, even just 1 month and 3 months later, we see significant selling even in the shorter end as well as 12 months after. But I would have loved to see in the 24-month stats right here, because I'm pretty sure this number would have jumped to like 80% positive. The risk to reward would be much better. So you do want to be a buyer of weakness where you see it. Now, we're also seeing stuff like personal interest payments, absolutely skyrocketing. Student loans, car loans, not so much home loans, not so much mortgages, but personal interest payments as a percentage of personal income have skyrocketed. Very, very scary stuff when you look at it. And the market is pricing in cuts, all things considered, and they probably should, because these signs are manifesting. The big boys have even greater data than I can show you on here. We are seeing 50% chance of a rate cut as early as March. Look at this, 14% chance of a rate cut in January. And we're even seeing a 13% chance of having the Fed fund rate at 3.5 to 3.75%. Now, here's a timeline that we can use. I'm going to break this down. So this is every recession since 1871, and they've sort of mapped it out. What happens is the curve steepens, credit tightens, what we're seeing, then the Fed has its first cut. We are right at this juncture right there. That is where we are. Credit tightens. When we get the first rate cut, could be in January, could be in February, could be in March, anytime between there. When we get the first rate cut, this is normally when we see equities bottom, and it could be anywhere from 9 to 12 months out. Personally, I think it's going to be a lot shorter than that. Why? Because if you go back to 2008, 2020, the Fed and the government are more reactive to what's happening in the market, and not just the stock market, the real estate market and the labor market too. Keep your powder ready. Once the EPS trots, the market is going to go on an absolutely violent rally. So how do we hedge in the face of all of this? If a recession is to materialize, big if, could be a recession, could be a bumpy landing. We could have neither. If a recession is to materialize in the next 3 to 6 months, your best hedges and how I'm hedging my portfolio is gold, treasuries, and large cap quality. The reason why I like these don't rely on timing the top. You buy, hold, dollar cost average at every 10% drawdown. Stocks normally bottom at a 23% drawdown, and bonds and gold will limit your downside, especially if rate cuts are to occur. The price of your bond is going to go absolutely soaring. So let's talk about treasuries. Let's talk about gold. Let's talk about stocks. And what am I doing with treasuries. Now, I have said that I am starting to build out my long bond position. I gave this to you guys on the 14th of November. If you're in America, it's the 13th. And this is right, I'm buying TLT. The ticker in Australia is GGov. It's literally the exact same thing. And I've been accumulating 20-year treasury long bond. I already had quite a bit of shorter term treasury, especially in the 3-month to 1-year range. And simply because, central banks have started cutting rates across the globe, and America is going to be no different. Generally speaking, emerging markets cut first in developed markets, and America is the strongest economy in the world. Normally they are the last to cut and the first to hike. But this is actually one of the longest time frames the Fed has taken to cut rates. In 6 of the last 8 tightening cycles, the Fed had already cut rates at this point onwards. So we are in a very, very tight tightening cycle by the Fed. Just something I wanted to point out there. And these are the returns we can expect. Assuming a 30-year treasury bond, let's say rates fall 150 basis points, you can expect about 33.5% return in total return. On a 20-year, about 26%. And what I would personally do with your treasury portfolio when buying treasuries, build out a long bond position in the 20-year, the 25-year plus, build out something in the 5 to 10-year, and then also hold these shorter duration, 3-month, 6-month treasuries, 1 year. And these are the returns you can expect, especially if we are going to go on a pretty aggressive rate cutting cycle. Now, let's have a look at gold, guys. Now, the second thing I want to talk about is gold versus the S&P 500 during recession. The allocation I'm going to keep in gold is very, very small. It's probably going to be 5 to 7%. Treasuries is going to be about 20%. Have a look at the returns on gold. Let's have a look. 1973 recession. The S&P 500 returned 13%. Gold returned 87%. Let's go to the most recent one. 2020 recession. Okay. Gold returned in that year 5.6%. The S&P 500 returned negative 1.4%. So in a recession, gold is a very, very good store of value because when the Fed decreases rates, it brings a lot more money into the system, and gold is a hedge against fiat currency. And when the Fed does cut rates, gold goes on substantial rallies. In the year 2000, 66%. The GFC, 189%. And again in COVID, 50% return after the Fed cut rates. And this is where we are right now. And same thing, if Fed cut rates, gold is going to rally. And we did see gold at 2000. It did make an all-time high, and that's bullish. It did come down substantially, I know, but anything that makes a new all-time high is very, very bullish. Now let's talk about equities. And you guys know that I'm staying in large cap quality. I only buy quality stocks. I don't buy dog shit. Okay. If I'm buying small cap stocks, I'm buying quality stocks. If I'm buying mid cap stocks, I'm buying quality as well as growth. Generally speaking, growth stocks tend to be high quality. And this is different types of factors and size of stocks in downturns. And you can see here that if we have a look, large cap, growth, value, and a blend of the two, on average during a recession returns -9%, -8%, whereas small caps and mid caps perform significantly worse. But if we actually have a look at factor benchmarks, have a look at USA quality factor, a -3.57% on average returns. Now in December in the GFC, it was -16, but it still outperforms value, momentum, minimum volatility, high dividend, and small stocks. Okay, and this is why I think having large cap quality in your portfolio is absolutely ideal, because there's one of 3 scenarios. This is how it pans out. You get the deep recession, okay, and bonds and gold are going to do really well after rate cuts. We get a very soft landing. We get minimal rate cuts. Bonds still do pretty good. Gold does nothing, and you're still in large cap quality stocks, which is going to outperform. Or we just don't get a recession and your large cap quality stocks just absolutely fly. And that's the reason why I want exposure to equities if we don't get a recession. Now, this is something I also wanted to point out to you guys. If the Fed cuts rates and we don't get a recession, these are the returns we can expect, okay? So the Fed cuts rates, we don't get a recession, we can actually see 12-month returns in the S&P 500 of 10%, 18%, 28%. Very, very positive stats. In these years right here, October 84, 89, 95, 98, Fed cut rates and we didn't get a recession. Outsized returns, okay? If we actually have a look at the times when the Fed did cut rates and we did get a recession, this is why you want to hold bonds, okay? But this is why you also want to hold stocks. And lastly, let's talk about cash. Now, normally what I do is I invest pretty much every single week into my portfolio. I'm actually going to reduce the amount of money I put into my portfolio every week to stack a bit of cash in my money market fund, because right now it is paying 4.75% still. That is everything I'm doing with treasuries, gold, stocks, and cash. And most Wall Street estimates are still pricing in growth. You have to understand this. If earnings in companies do grow, right, stocks are going to rally. You do have to understand that. Now, what you guys have to understand is that Wall Street is still expecting about 9 to 10% growth in earnings. And if that is the case, stocks are really going to rally. Sure, we might get a drawdown, but it's going to be met by a sharp increase. So you definitely want to stay in stocks, because as it stands right now, according to Yardeni Research, who have been extremely accurate with their forecasts, we are expecting growth if that's the case. Now, I'm not saying that this is the start of the next bear market. We are in a seasonally bullish month. We are in the strongest period of the month where Vana and Charm flows are the strongest. There's huge dealer support in this week, but especially in week 2 and week 3 of December, where we are right now, guys. Now we are moving into week 2, and there's going to be huge amount of collateral reinvestment, Charm and Vana flows that are coming into the market. And that's when we can expect, and that could be supportive to equities. I stress this. This is why you want to be in stocks, in bonds, and gold. You want exposure to all, and you want to be in qualities. Let's have a look at the month-to-date performance of the S&P 500 and seasonal performance. So this is where we are right now. We are diverging a bit from seasonals, and this is what we can expect in December, sort of trepid action for a rally from about the 11th, 12th, or 13th trading day in the month. But this is where we are right now, and let's hop on the charts and have a look at the price action today. Now, this is the year-to-date chart of the S&P 500. We've had a very strong year, and my thesis for this week is quite simple. We're going to chop in this area right here and potentially seeing a high of 460.30. I doubt we get below this point right here. 4501 is where we see negative gamma, and it could lead to further sell side, but I do think that all dips to be met by bull demand into this area, at least according to dealer flows, dealer positioning, and the fact that we're in positive gamma. Now let's have a look at some dark pools activity right here. We saw some pretty big buying in the TLT all the way up for the last week and a half. Biggest trade came in right here, and we've rallied ever since. And I do think that this is going to be buying. I do think that the 20-year treasury is currently sitting at 4.4. I think it's going to 4% in the next coming weeks. I'm really bearish on yields. Looking at utilities as well, we've seen some pretty active buying. What I want you guys to notice is this volume profile. There's a lot of volume right here. So even though in this area there isn't many trades, you can expect that institutions were accumulating in this area, looking for a hedge if we do go to the downside. Just something I wanted to note right there. And looking at energy, people are not liking energy, and the biggest trades are up here and here. Okay, probably shorts, because we aren't seeing any trades coming in at the bottom here. You know, if people were bullish on energy, you'd be seeing huge like dealer trades right there. We're not. So again, more bearish signs in energy, in utilities as well, with bullish action in utilities and materials. Have a look here. One of the most rate sensitive names is materials, especially in recessions. They don't do too well. Have a look at this. A ton of buying. You see this? This is a very strong level. We sort of got up here and then dumped. So these were probably sells or people just closing off their positions from materials. That's exactly what we're seeing right now. And we're seeing like very few buying at the bottom here. So let's talk about the upcoming data, because a lot's going to be reliant on this. We got ADP data. It wasn't that good. Trade balance and non-farm productivity was all right. We do get initial jobless claims on Thursday. It's not going to be too big, because we get the big one, non-farm payrolls on Friday, as well as consumer sentiment, and then hourly earnings month over month, year over year. So guys, if you like this video, please subscribe, hit the notification bell. You know I love you guys.